How you doing? I'm Big D. Thank you for stopping in and spending a few minutes of your day with me. Now, I'm Big D, and hopefully you like what you see. The information that you're going to receive today, especially if you're a silver stacker, gold stacker, etc. There's a lot going on. I want to talk about this because something is moving inside the silver market right now, and most people scrolling past this and they're on their phones or you're watching it on your TV probably don't know what's going on. So that's why I'm bringing this to you. I just found this out. In just 14 trading days, silver ripped through levels that analysts told us were impossible this decade. And yet it happened. Gold, the metal everyone watches, is still sitting stagnant, so to speak. But silver is doing a little bit of sprinting. Now, if you remember, gold is the one that usually moves, and then silver straggles along a little bit. And when these two metals stop playing around, history says something big is about to break. Central banks, especially central banks, when something happens with them, you got to listen. That haven't touched silver in hundreds of years are suddenly stacking it. Asian vaults are pulling in tonnage at numbers that have never been seen or been recorded that we've been watching. And before the iPhone existed, American warehouses are draining premiums in Shanghai, which have exploded into double digits. And a brand new Federal Reserve chair just walked into a $40 trillion debt trap with no exit door. This isn't a rally, this is a repricing. You're watching fin shift, but we're seeing a lot of different shifts. But silver moving the way it is not normal. Like I say, gold moves first, gold moves the most aggressive, and silver moves along with it. What we saw in the last couple of weeks as well is the gold to silver ratio dropped to the low 50s. I think I've seen it as low as 53 to 1. And over the next few minutes, I'm going to talk to you about exactly what's happening, why it matters, and what the smartest money in the world is quietly doing about it before the rest of the market catches up. Now, if you don't mind, hit the subscribe button. We're trying to build a show here, especially if you like what you're hearing. Drop your city in the comments so I know where in the world you're tuning in from. Leave a little comment as well. Like if you're a silver stacker, if you're just beginning, that would be great to hear. Now let's start with the numbers because numbers don't argue and they don't have opinions. At the end of April, silver was sitting quietly around $71. Very boring, sideways. Most retailers, investors had written it off. Many of them were believing that they bought in 90, $100, 110, 120, that now they've been duped. But the forums are dead. The YouTube videos weren't getting views because it was stagnant. There was nothing going on. I haven't been on in a few weeks myself. The metal had become invisible. Then, almost without warning, the chart cracked open again. Within 10 days, silver was trading above 73. A week later, it pushed past 80. And by the middle of May, it was printing prices in the mid 80s. Now, that's a move of nearly $14 in a window so tight it caught even seasoned traders off guard. Now, you might see today's pullback, or not today's, but Friday's pullback, and assume the party's over again. Well, pullbacks inside structural moves are not the ending. They're the beginning, in my opinion. And we're going to see some pullbacks. It's just inevitable. It's the game that they play. They use the derivatives or the fake silver to manipulate the market. They've done this for multiple years. But if you look at the COMEX, the LBMA, Shanghai, they don't have anything to sell. And they're out 2 to 3 months before delivery. And they're hoping that they don't have to deliver, because then it comes off what they have to sell or that is available. Now, the buyers stepping in underneath this market are not the same buyers who showed up in 2020. These are deeper pockets, quieter pockets, and they're not flipping, they're accumulating. Here's the detail almost nobody is talking about, and it's the most important clue on the entire board. For as long as most of us have been watching markets, silver has been gold's little brother. Gold leads, silver follows. Gold rallies, silver rallies, a little slower. Gold drops, silver drops twice as fast. That was the rule. That was the relationship between broke over the last several sessions. We've watched gold trade flat, sometimes even slightly red, while silver climbs $2 or $3 in the same window. The divergence is not random. That divergence is a fingerprint. It's the fingerprint of structural demand showing up in one metal, but not the other. But why? Because gold and silver, despite sharing the same shelf in the local coin shop, are two completely different animals right now. Gold supply is tight but stable. Silver supply is an actual, measurable, documented deficit. In the moment a paper market can't hide a physical deficit anymore, that's the moment the price starts telling the truth. And that's what we're seeing right now. Silver isn't trading as gold showdown anymore. Silver is trading on its own gravity now. And that gravity is pulling in one direction. Now let's travel east, because that's where the real story lives. While Western traders are staring at red candles and panicking on Twitter, sometimes extraordinary is happening in Shanghai Gold Exchange. Physical silver prices, there have been touch levels near $100 an ounce, not a forecast, not a projection, an actual transaction settling in the largest physical market exchange in Asia. Now, compare that to what you're playing in New York. The U.S. spot price has been hovering in the low 80s during the same window. That gap between somewhere between $14 and $16 per ounce translate into a premium worth 16%. Think about what that means. Chinese buyers are willing to pay 16% surcharge over the Western paper price just to get their hands on real metal. When premiums of that size appear in any commodity market, it's never an accident. It's a signal that the official price and the real world price have started to disconnect. And that's a good thing. And there's an even deeper layer underneath this. The Shanghai futures market is currently in something called backwardization, a fancy word that simply means buyers are paying more for silver than for silver deliveries later. In every commodity textbook ever written, backwardization means one thing: a physical shortage is here, and it's here now, and it's here to stay. Let's zoom out to the country level data, because it's where the story stops being a chart and starts being a strategy. In a single recent month, China imported roughly 836 tons of silver. To translate that into something your brain can definitely hold, that's around 27 million ounces of physical metal pulled in within 30 days. That figure is the highest monthly silver import number China has recorded in 17 years of available data. Not a high, not a peak, the highest ever recorded. So the obvious question becomes, where is all of it going? The answer, uncomfortable for Western analysts, because the metal isn't being flipped, traded, or recycled into ETFs. It's being absorbed into industrial supply. chains, into solar panel production, into electronics, into state reserves, the hands that have no intentions of ever selling it back. And this is what accumulation looks like when a superpower decides a metal matters. Don't forget the military purposes as well for silver is huge, especially right now. Russia, Ukraine, United States, Iran. We got a lot of war going on right now, and it requires a lot of metal. Now, it doesn't announce itself with a press conference. It shows up quietly month after month in customs data nobody is reading. Until one day, everyone realizes that the vault in the West are empty and the vaults in the East are full. For the first time in modern history, Russia has officially added silver to its National Reserve Plan. Read that line again because it's bigger than it sounds. Russia, a country that is historically built in monetary strength on gold, oil, and foreign currency, has just opened a brand new chapter. In late 2024, the Russian government formally announced that silver would be included in its state reserve fund, a sovereign level commitment to accumulate the metal. Since that announcement, silver has quietly outperformed gold on a percentage basis. That's not coincidence. That's footprints. When a central bank buys silver, it doesn't pick up a few coins. It moves in tons. It moves consistently, and once the metal goes into sovereign vault, it's gone out of circulation permanently. And the rumor mill suggests Russia isn't alone. Whispers from the Middle East suggest at least one or two sovereign wealth funds in the Gulf region have begun building silver positions of their own. Officially, none of it is confirmed. Unofficially, the demand pattern shows up in the data only makes sense if large state level buyers are already active. And it all adds up. China at historic volumes, Russia at the sovereign level, the Gulf rumored, and India absorbing through trading and cultures. And you've got four major demand engines firing into the same shrinking pool of metal. While the East has been accumulating, the West has been bleeding. Silver inventories sitting in U.S. COMEX vaults have fallen back to pre-tariff levels. That metal didn't evaporate. It didn't disappear. It moved east quietly, containing by containers. Container by container, shipment by shipment. This is the part of the story major financial networks don't want you to lead with because it changes the entire pricing narrative. The silver market is no longer being driven by speculation desks in Manhattan or Mayfair. It's being driven by physical demand in Shanghai, Mumbai, and Moscow. Now, this is a tectonic shift. Now, that's how metal gets priced. 4 months, silver ETFs in the West were bleeding investors. Holding were shrinking. The narrative was negative. Sentiment was dead. Then the flow reversed. The most recent data shows 3 back-to-back sessions of net additions into the Western silver ETFs. The selling pressure has broken. And here's the part most people miss. Silver doesn't need a flow of new buyers to keep rising. It just needs existing holders to stop selling. The move from heavy outflows to neutral is on its own a massive bullish shift. The rumor of, well, let's talk technical, because if you're holding silver or thinking about buying, this is where it gets practical. Silver has run from the low 7s into the mid 80s, is roughly 2 weeks. No, that's a vertical move. Vertical moves always meet resistance. The next major resistant bands sits somewhere between $88 and $90 per ounce. The first time silver knocks on the door, expect profit taking. Now, also expect a fade. Expect the headlines to scream that the rally is over. It won't be. The second test is the one that matters. The silver push cleanly through $90 with conviction and volume. The next measure move, based on classical chart structures, opens the door to triple-digit territory again, with technical targeting stretching past $115 per ounce. In long-term technical picture, some of the most respected chartists in the precious metal world are openly discussing price targets that a year ago would have sounded insane, like $300 to $500. And those next quarter forecasts, no, but are they the forecast? No, but are they one on the long-term map? Absolutely. The destination in the world of more than one veteran analyst is not really a question anymore. Only the timing is. Now let's lift our eyes from the silver chart and look at the macro picture, because this is the foundation underneath everything we're discussing. Recent inflation data came in hotter than expected. Recent consumer prices climbed faster than the forecast. Producer prices, the wholesale level numbers did the same. And here's the truth. Most retail investors keep missing. Inflation is not a temporary visit. Inflation is the dominant macro force shaping the precious metal market for the next decade. Everything else, rate decisions, Fed press conferences, political headlines, is noise built on top of that one variable. And the Federal Reserve just got a new captain, Kevin Warsh, has been confirmed as the next chair of the Federal Reserve. The political pressure is to bring rates lower is very loud. Public is ongoing. Walsh himself has been openly critical of the previous monetary regime, even using the phrase regime change in the past interview, a phrase that carries serious weight in central banking circles. The market is pricing high probability that rates stay unchanged for the next meeting. But here's the kicker. Gold and silver have been climbing anyway. That single fact tells you the era when the Fed could control precious metal prices through interest rates, moves in quietly and ending. Here's why the Federal Reserve is structurally trapped and why that trap is the single biggest tailwind from silver. Back in 1980, Paul Volcker famously crushed inflation by raising rates to 15%. He could do that because the U.S. national debt at the time was around $1 trillion. The math worked. Today, the U.S. national debt is closing in on $40 trillion. Run the math at 15% on $40 trillion, and the annual interest expense alone climbs into the $6 trillion zone. That's not sustainable. That's not even theoretically possible. The tool Volcker used to save the dollar has been physically removed from the toolbox, which means real interest rates, the gap between official rates and annual inflation, will keep widening. And every time that gap widens harder, as assets like silver become more attractive. So I just want you to be aware. These are the things that are going on. Have a great day. God bless. We'll see you soon.